Welcome back to this week's chart scan. My name is Marco Mayer from Trading Educators, and today we're going to have a look at outside bars looking at the E-mini Russell 2000 future. So let's start. First of all, what is an outside bar? An outside bar simply is a price bar where the high of the bar is higher than the high of the previous bar and the low of the price bar is lower than the low of the previous bar. In other words, the range of the bar totally engulfs the range of the previous bar. On this chart, I've marked all outside bars with blue bars, so each price bar that's blue is an outside bar. I'm especially interested in outside bars that are defined as strong outside bars. I don't like bars where we have an outside bar, but at the same time a lot of indecision, like for example, if you look at this bar, technically it's an outside bar, but the open and close are almost the same compared to bars like this one or this one where we have a weak close, or looking at this bar where we have a clearly strong close, so no indecision. Now how can we put that into a formula to be able to backtest it? How we're going to do that is simply by adding a small filter to it. So it's still the same definition as before. High has to be higher than the high of the last bar, low has to be lower than the low of the last bar. So we take the open minus the close and take the absolute value of that so that it works for both up and down bars, and divide that by the range of the bar, meaning the high minus the low. And I want to see this relation to be bigger than 0.5. If it's less than that, I'm going to filter them out. And on this chart, every bar that has one of these red markers is a strong outside bar. Those who don't have it are weak outside bars. So how do we test an entry signal to see if it has any potential? The easiest way to do it is just to take the signal and have a look, okay, how does it perform if we get in at the market once the signal occurred and then simply get out on the close of the next day, or close 2 bars later, 3 bars later, 4 bars later, and so on, without using any specific profit targets, stop losses, and so on. Because all we want to look at is, has the entry signal any potential? Is it any good? Now, if we add any other stuff to it, like a trend filter and so on, or a specific exit strategy, then we won't really know too much about the signal itself, because then we are testing basically a lot of things at the same time. So to keep it simple, I create a little strategy here. So this is a long entry. We want to buy if we have an outside bar, the close is higher than the open of the bar, and it's a strong outside bar. So in other words, whenever we have an outside bar going up, we want to buy, and we do the same when we have an outside bar that's closing lower. We have a down outside bar, then we want to sell. And we simply do this at the market, meaning on the open of the next price bar. Again, here's the same rules for the short entries, just the other way around. So we want to close that's lower than the open, same pattern, sell at the market. And our exit signal in this case simply is, okay, if we have been in the trade for so and so many bars, we want to exit on the close of the price bar. So we have one parameter here, which is the time stop, meaning after how many bars do you want to get out. And as you can see here right now, it's 1. So let's say we've got a short signal right here, right? We enter on the next price bar at the open. Here we've been in the trade for 1 bar. Now we exit at the close of the next price bar here. Same exit strategy for long signals. We've got a long outside bar here. We get in here and exit 2 bars later at the close. Okay, time to run some back tests. Now to do so, I'm going to look at the Russell 2000 mini contract, including the overnight session, starting from 2009 till today, which is February 2016. Again, this is not a tradable strategy. Also, the idea of this video isn't to give you a tradable strategy. The idea is to give you an idea of how to backtest an entry signal. So let's start. I'm going to run this backtest, optimizing through the time stop, meaning I'm going from 0 to 50 periods. So here we got some numbers, and what we can see here is the result for each of the backtests, each of the optimizations using the time stop, going from 0 bars to about 50. And as you can see, from 2009 till today, this strategy did surprisingly well. We've got quite stable results going on here. Everything's positive. With 7 bars, it's less good than with 1 or 2 bars. And it's less good starting again than with about 10 bars. Meaning this might tell us something about what kind of prediction this pattern can make. So in the very short term, it seems to perform quite well. If we look at the results, for example, for exiting after one price bar of being in the trade, we get about $35,000 profit, which doesn't tell us too much, but the profit factor of almost 2 is very nice for such a simple pattern. Also, the equity curve looks okay. And if we look at the long and short trades, quite surprising that the short trades actually did better than the long trades. And that happened in a market that basically just moved one way. So the equities have been in a strong uptrend during the last years. So that's quite surprising. I would have expected this to be the other way around. And yeah, that's for me, that's something to write down, because it's quite difficult to find good short entry signals for the stock markets in general. They are much more easy to trade on the long side, and whenever you find something that can work on the short side too, make a note. Might be interesting for the future. Now, if you stay in for longer periods, the profit factor goes up even more. So if we look, for example, okay, what happens if we stay in for 20 days, which is about 1 month? The profits are much higher. We also get stronger drawdowns, of course. Another market where this pattern works quite well is the Nasdaq 100 future. Again, the E-mini one. Pretty much the same picture as for the Russell. And now if we look at the E-mini S&P, things look a lot worse. So here the pattern doesn't give us any good results at all. And of course we now could look at all kinds of markets. But I guess my point has been made, which is showing you a way how to actually test an entry signal, see if it's any good, and then you have something to maybe build a strategy around. So you could take this signal, for example, and think about, okay, what could a good strategy be to use it in? So what kind of exit signal makes sense or doesn't make sense? What kind of start makes sense? Maybe doesn't make sense to use profit targets. Are there any filters to use, for example, a trend filter? Or does it maybe make sense to look for ways to get in a better way than just using a market order? Maybe getting in with a limit order is a better idea. All kinds of stuff. So that's just one part of a potential trading system or trading plan. So my conclusion for today is that yes, the outside bar is an interesting pattern trading the E-mini Russell, at least during the last couple of years. If you look at the data before 2009, it looks much worse, which might be due to changes in the contract. Maybe the session time changed or something like that, or the market just behaved in a different way. Thanks for watching. Hope to see you in the next episode of ChartScan. If you're not a member yet, you can subscribe for free at tradingeducators.com, become a member there, and check out our previous articles and videos. Or if you have any questions or want me to answer another topic in the future episode of ChartScan, you can send me an email at marco@tradingeducators.com.